As a minimum, just keep records at the start. And actually, it's a requirement in law to keep records for your business for a minimum of 7 years. So KRA can come and investigate aspects that deal with your business that happened the last 7 years.
What is the advantage to the business owner when you're able to do this in the correct manner? Why should a business or why should an entrepreneur be able to do this in the right way?
Very, very, very good question. I think, and it's fundamentally is what let's call it compliance. Compliance is very, very key. So the cost of compliance outweighs the cost, any benefit you'd incur in terms of evasion of tax or outright not non-compliance of tax. It's the cost is too much. So let me give you an aspect. So, for example, if you are a business owner and you charge VAT, and once you are VAT registered, the requirement in law is to always file tax returns every month. Every month you fail to file a tax return, the penalty is 10,000. So if you over time you've accumulated 10,000 per month, a year it's already 120. 6 years, that's already 720. The cost just becomes, and it's very hard to get those to be removed. You have to actually pay. And that's just the minimum. Now, if KRA come and assess that you have tax liability, you have not been paying taxes, first there's a disruption. Number one, they'll assess taxes based on improper records. So, for example, because KRA don't have access to your records. You're the one who if you don't keep proper records, they'll come and say, give me your bank statements. They'll look at your bank statement and say, any money that is coming in, that's income. Prove it's not. If you don't have records, you can't prove it. So anything that's coming in is your income. Then they'll say that this year you collected 10 million, that's income. They'll do 30%. They have no regard to your expenses because you have no records. You have to prove to them that that money that came in was a sale, and this is the cost of that sale. But if you have no records, you can't prove it. So they'll just calculate tax. So the tax cost will be higher even. You'll end up paying more taxes. So first you will pay the tax on that income. Then secondly, you will pay a penalty. Penalty is between 25% of that tax that you have not paid. Then you will pay interest. Interest is calculated at 1% of the unpaid taxes every month. So if you have not paid taxes for a period of time, it becomes a whole thing. Then, so they give you a tax bill and they tell you, maybe you can work out an arrangement and pay it slowly. But the disruption in business is costly. The amount of time it will take you to deal with them, to engage with them, and also now come and engage a tax consultant to also help you. The cost is just too much. So it's easier to be compliant from the get-go rather than be non-compliant. I know there's this sort of trade-off that we put, that if I pay taxes, I should see value for it. It happened, and it's human nature, and it's actually not, as in, even for me, you feel sort of that if I pay this tax, I should see
that if you are paying taxes and people are stealing.
Exactly, you have to see you don't get there. You don't get it when you are paying and you don't see the value for that tax. So now I think it's there in the back of your mind. But trust me, the cost of not paying is even higher. You'd rather pay. Just tell your God that I am just doing this for to be a responsible individual.
Yes.
But it's because it will save you future headache. It will definitely save you future headache. Yeah.
And in terms of the cost, still on the cost of it, can it be able to make you lose business?
Yeah, so because compliance has many aspects. So, for example, if you are, especially entrepreneurs are always looking out for government tenders or even other private tenders. And part of the requirements to tender is to give a tax compliance. If you're not tax compliant, you won't be able to get those tenders. So even your business is lost. Then one of the things that KRA have far-reaching mechanism for collections. When I say far-reaching, it's quite far-reaching. And one of the ways they do that is that they have what you call agency. They can write to your bank and tell the bank to pay taxes directly to KRA. So what happens is that a letter comes to the bank and says, please, on this account for this business, we have put an agency on this, so please pay any monies that come to this account to clear this tax balance. So that bank, whatever money comes to that bank account will only go towards paying that taxes. Until that tax is completely paid off, that's when now they lift the agency notice. So it's the cost of running your business is not affected. You don't have cash flow to run your business because your banks have been frozen. No, that then if there's not enough to go far, there's not enough to go to pay. If there's not money enough in the bank to pay those tax liabilities, they can go further, even auction assets, business assets. They have far-reaching ways of collecting that tax. So it's not in your best interest. And there's also that element of tax evasion, where you are outrightly not paying taxes. Then that becomes a criminal matter. Mm-hmm. Yeah. So it's not worth it at all.
Yeah, and also as you say, the government agencies that you're doing business with, even private sector, most of them would want to see the compliance certificate before you engage with them in some of the businesses. So I think somebody might lose out quite significantly when they do not have good practices in terms of the compliance.
Compliance, yes.
And there is also, Wilson, there is also the element of now from the advisory part of it. As a business, I want to pay minimum taxes. I want to pay the least legally. Yeah. How do I go about that as a business?
And that's one of the things that I get asked a lot. What the proper term for it is what we call tax planning. You're basically maximizing what is available to you in terms of how much tax to pay. Again, it's not the frame how you ask that question would imply an element of I'm trying to sort of avoid or evade, which again is very, very wrong. It has the implication is quite there. So, but in terms of taxation, sadly, we're not like other jurisdictions in the world like America or Britain where they have more ways. So, for example, in Kenya, it's very, very clear.
Yeah.
Taxes. As a business owner, you take your income, you less expenses. Now your expenses they have defined your expenses are anything that helps you make that income. So that's the only way, maximize on expenditure. So anything that helps you make that income that is always what is termed as can help you pay less taxes in a sense. So at the end of the day, have a record of everything that you've bought, then you assess. Then it's assessed. Then it's when you're doing your books, you will see your income less your expenses. Whatever is there as profit, you will pay 30% on profit. But you see, so anything here, income is what you have sold basically. So that can't be changed because money has already come in. Now expenses, what you have bought, you have to maximize on that. That's the only way, so that to ensure that the profit is not as profit will be reduced, that you end up paying less tax. But again, so the expenses critically have to be matched to the income. But other aspects, so another thing that you can maybe add on, for example, and it's allowed in law, is that the law allows you to add to claim medical expenses up to a certain limit. So it's, I think, 1 million shillings a year. So that's an additional expense. So see, when you pay for medical insurance or medical bills, you see there's no direct correlation to the income, but it's an allowable expense. Yes. So there are certain elements that you can add to maximize on expenses. That's legally the only way. There are very few. If somebody were to tell you they'll be lying to you.
So there are very few ways of being able to do it. So,
but I think it will be prudent for me to talk about aspects that for a business owner would be hard value. So let me talk about employment income, even as this will be more geared towards employees, but there's an element also for sole proprietors to see value, and also for director. If you're running a limited company, as a director, you can also be an employee, and there's value to that. So another way to maximize on expenditure is for employees. So let's start with employees. When an employee, when you as a business, when you have an employee, and you pay them currently more than 24,000 Kenya shillings in a month, you as a business owner are obligated to withhold their taxes and pay to the government every month. That is what we call pay as you earn. So what happens for the employees, if you pay them more than 24,000, you withhold their income tax and pay it to the government on their behalf. That's pay as you earn. So for the employee at the end of the year, when they are filing their returns by June 30th, they're not paying any extra tax because the employer already withheld the tax and paid it to the government. All they are doing is just declaring that I earned this, the taxation of the tax was this, and it was already paid.
Yeah.
So yeah, now back to the employee. So for an employee, again, employees are taxed at the same rate. Graduated is a graduated scale. In 10% first, then goes to 20, then it goes to 30. It's just very simple. It's a graduated scale. So, but they are what we call, so and for an employee, what is taxed? Your salary, your bonus, your allowances, your benefits, all that is taxed. If you're given a graduate, all that is taxed. Anything that comes to you as income from the business. If the employer gives you a car to use for either personal or for business, basically most of the time it's a mix of personal and business. It's called a car benefit. That is taxed on you as an employee. It's taxed on you. So anything that is given to you from the business is taxed for you. It's taxed on you. So you can pay less tax if you do certain things. Number one, if you contribute to a pension. As an employee, if you contribute to a pension every month, that is an allowed deduction on your income. So before you're taxed, so if you earn 100K and you contribute to the pension every month 10,000, you will be taxed on 90,000. Unlike an employee who earns the same 100 and doesn't pay pension. If he doesn't pay pension, the employee earning 100 will be taxed on the full 100. But an employee who pays pension will be taxed on the 90. Makes sense?
After the deduction of the pension.
Yes, after of the pension, will be taxed on the 90. So people who contribute to pension pay less tax. I hope that makes sense.
Yeah, it makes sense.
Yeah. So then,
does it apply to insurance?
I'll come to that.
Oh,
so
okay.
So that's number. Then number two, if that employee, if you have a mortgage and it's critical, a mortgage for a house you live in or you're constructing to live in. You can't have you can have a mortgage for a rental or whatever, but you see that's not a proper mortgage. A mortgage is for a house you live in or you're constructing to live in. That's the goal of that. They allow you to deduct up to 25,000 per month on the interest you pay. So for example, if you have a mortgage that pays, say, you pay 50K and the interest on that is, say, 15,000 every month.
Yeah.
So for the same employee who earns 100, I'll pay tax on 100 less 15, I'll pay tax on 85,000. So if somebody doesn't have a mortgage, then they'll pay tax on the 100K. So those two things, so mortgage and pension. If you pay mortgage and if you pay pension, you're allowed a deduction. So that's how you save as an employee. Mm-hmm. Those are the biggest ones. So now it comes to this other end. So when you ask about insurance if you have an insurance policy, this is a life insurance policy and also an education policy. And now they included actually medical. But the two ones that are very clear is a life insurance and a education policy. A life insurance can be taken out on your life so that it covers you in case of death. And education policy is critical. That education policy, you take it out on yourself or for your beneficiaries, the children. So that education policy, the critical element here, has to have a policy term of more than 10 years. Not 10 years, more than 10 years. That's the goal, more than 10 years. So that when that happens, you are allowed what we call a relief, an insurance relief. So, for example, after the 100K, say your tax liability, your tax payable is say 20K. Before paying the 20K, you are allowed a relief of tax. This is not a deduction; it's a relief of tax. Before paying the 20K, you are allowed to deduct 15% of the premium that you pay for insurance. So, if your insurance premium is 10,000 a month, you are allowed 15% of 10,000 is 1,500. So before paying the 20,000 tax, you deduct 1,500 and pay 18,500. So you are allowed a relief of an insurance premium relief. It's called a insurance premium relief. It's not. It's deducted against the tax that you ought to have paid. So that's the benefit of paying insurance. Yes. You can go about saving some bit of tax and having at some point a bit of extra cash. If you are saving, if you're having a mortgage, and you are contributing to pension, yes. And pension also includes, just for information, NSSF. If you also contribute to NSSF, that's also a pension. It's also considered a pension. So that's one of the biggest ways, and as an employee, you can save. So directors of limited companies who earn a salary can also take advantage of that. So contribute to pension, do mortgage, and then have those deductions on their monthly payslip, so they end up paying less tax. Another thing that I think is worth mentioning. So for limited companies, what happens is that after you calculate your profit, you do 30% as tax. Whatever is left is what we call now net profit after tax. Those profits are distributable to shareholders as dividends. So before paying shareholders those dividends, there's another other tax called withholding tax. So a 5% tax is levied on the dividends. So before distributing the excess profits or the remainder profit, you have to withhold 5% as withholding tax and give the rest to the shareholders. But now, to make it the best way to maximize on taxation, you'd rather pay, you as a director, because also a shareholder, you'd rather pay yourself extra salary. The tax on salary, you'd rather pay yourself extra salary rather than take dividends. It's very important. You'd rather pay yourself, because when you pay yourself extra salary, you'll be taxed at what you call the graduated rates, which is not as much.
Which is more friendly.
Exactly. So it's one of the ways you can maximize on tax.
Oh, yeah. I get it. So this 5% on dividends is more of like on income to the shareholders.
Exactly. But you see, this income has already been taxed at 30%.
30%.
Now
so
there's another further 5%.
So, okay.
Yeah.
I get it.